Hello, and how are you doing? I want to believe you're doing so good. Since the last time I posted a video yesterday, if I'm not wrong. It was about breakup blocks, right? So when I posted that video, a lot of people came into my inbox and asked me if I can give the difference between a breakup block and a mitigation block, and I promise you that. So that's what we're going to have a look at today, and it's a very interesting one. Yeah, okay. So first of all, guys, if you're watching this video and you've not subscribed, you're doing the wrong thing. Please subscribe, and I'll be so thankful, right? So let's go right away into the charts. First of all, let me give you a skeleton of it. Let me just show you something. And if you've not watched a video about the breakup logs that I posted yesterday, please do, so that at least you can, when I'm explaining about the mitigation blocks, at least you can get the difference between the two concepts of ICT, right? So please go back and watch that video. It's about breakup blocks. It's in my YouTube channel. And then you come back to this, right? And then so you can at least try and, figure out the differences, and now you can apply, and now you can spot them, right? In the charts. Okay? So what I said yesterday, let me draw it. Okay, assuming this is a market structure like this, and then the market shifted like that, trading into this the point of interest, higher time frame swing point, and then drop down, traded higher, but it fails to break above the previous high. Okay, it fails to break above the previous high, or causes or fails to cause a break of structure. It traded down below this swing, traded down like this, and then kind of retrace and then down. Okay, so my point is when you see something like this in the chart, now if at all the price fails to break that high, this one, after sweeping the liquidity and fails to break this high, I consider the first candle here to be my mitigation block. I don't know if you're getting this, guys. Okay, I don't know if I get, but please just try and understand. It's very simple. Just don't complicate it. Okay, don't complicate it. And I, if you have the knowledge of the breakup blocks, especially if you watched my video yesterday, you will really get to understand the differences between the breakup block and the mitigation block. I said breakup block causes a break of structure. Breakup block causes a new high, but a mitigation block does not cause a new high. Okay, so in a scenario where you get something like this, let me give you something like this, like that, traded into that zone, sweep the liquidity, come back down like this, up, down, retrace, boom, down. Okay, so in a case like this, where there's a sweep, traded back down, caused a new high right here, just traded above that high, causing a new high. Okay, and then trading back down, displacing below this low. Okay, because it caused a break of structure and traded below the low, this low that caused this swing to break above this level. I consider this a breaker block. the last candle here is a breaker block. Okay, that is a breaker block for me. So you find the difference. Mitigation block is the last candle or the first candle that pushes the price up to cause a failure swing. So for me, this is a failure swing. Okay, so this is a failure. That's a failure swing. Okay, this is a failure swing. This one. So this candle that pushed the price higher, causing a failure swing before price dropping down, displacing below this low, is called a mitigation block. In this case, this created a new high. This created a new high. So the last candle, the first candle right here, that pushed the price higher, breaking the structure right here, and then dropping down, causing a displacement below this level, is called a breaker block. Let me believe you're getting the difference right now. Really good. Okay, so let's go back to the charts right away. We can really identify a lot of them. A lot of them. So the main focus for me today was about mitigation blocks, because I already posted a video on the breaker blocks the other day. So please go back there, watch, then come back to this, watch again, and then you'll find the difference and how you can apply them in your day-to-day market analysis. All right. So let's consider this price pattern. Let's consider this price pattern. Let's consider this price. It traded into this 15-minute order block. Okay, 15-minute order block. And ideally, when the price trades into that point of interest, the order block or any institutional reference point, you expect a reversal. Okay, you expect a reversal if the point is respected, okay, or disrespected. So once the price tapped this order block, the price went back higher. Okay, so the price went back high, as you can see, right from there to that point. Okay, and the price immediately came back low like this. But you see, this low fails to break this low, or it fails to displace below this low, this previous low. Okay, I hope you are really following up on this. It failed to break below this low. Okay, this came back down, failed to break below this low, this one right there, and it traded back higher, displacing above this high. So that was a displacement above that high. Now, what I'm expecting to point out is a mitigation block. So my mitigation block would be this candle, the last candle that brought the price down to cause a failure swing right here, and the price traded above it, displacing above it. So my point is, this will be my mitigation block. Okay, this is my mitigation block. I hope you are really watching that. Okay, this is my mitigation block, and you can see once the price tapped higher or just traded above it, displacing above it, the price came back at this point, tapped the mitigation block, then went back high, all the way higher. Okay, so at this point, I believe you can see how a mitigation block differs from the breaker block. Okay, a mitigation block causes a failure swing, but a breaker block breaks the structure and causes a new high. Okay, a new high. For example, in this case, uh, if you can consider this, let me see, this one. This for me is another mitigation block. Okay, that's another mitigation block. Why? Because that's where this price began. Okay, that's where that price began and failed to trade above the previous high right there. So the first candle that traded above, causing a failure swing, for me is a mitigation block. And you see how price traded just below it, displacing down, closing below it, going back up, and then trading back down. All right. But in a bigger picture, let me show you something. Okay, in a bigger picture, this, okay, sorry. Let's have a look at this. This, the new high was created right here. Okay, the price traded, dropped down, and let me believe the price traded into a point of interest just back there. So the price traded like that, dropped down, pushed back higher, causing a break of structure right here. Okay, this is a break of structure, or you can consider it as a liquidity sweep. It caused a break of structure right there, right here, and then traded back down below this low. Okay, below this low, below this low. So for me, I will consider this first candle as a breaker block, not a mitigation block, because I said a mitigation block causes a failure swing. Okay, causes a failure swing, but a breaker block causes a new high before trading back down, displacing below the low below the low where the price began. All right, so this is a breaker block and this is a mitigation block. Okay, okay, now let's go back to another chart. Let's go back to GBP USD. Let's see if we'll find something of the sort. All right, now let's have a look at this chart again. As you can see clearly, that was a liquidity sweep, right? This was a liquidity sweep just right here. Okay, and the price traded down it, sweeping the liquidity. Sorry, I think my network is really bad. Okay, so that's basically what I'm talking about when I talk of the breaker blocks and the mitigation blocks. Okay, the breaker blocks and the mitigation blocks. All right, now let's look at another example. Let's look at another example. All right, let's look at another example. In this case, sorry, this case, when the price traded below this low, pushed the price back high, trading above this high and closing above it right there. This first candle that pushed the price down, causing this break of structure, I'll consider it as a breaker block, this one. And I expect this to push the price higher once the price tapped it. Okay, so like you see, the price traded above it, displaced above it, traded back it, and then just went up. Okay, so that's basically how you can expect the same thing in the market when you see the same scenario, right? So that's all about the mitigation blocks. Like I said, mitigation blocks causes a failure swing, but a breaker block causes a break of structure. Right? A break of structure. So the whole point here basically uh, lies on a break of structure and a failure swing. A new high and a failure to cause a new high. When you see a failure to cause the new high, look for a mitigation block. When you see a break of structure causing a new high, that is a breaker block. And just apply this at the points of interest alone, okay? At the points of interest alone. Don't apply it anywhere else, because you might really not be happy about the results, okay? So basically, you can go back test this again. Go back test this in all the assets that you trade, and you'll see how it really works, okay? So thank you for watching. Thank you for coming back to my channel to watch my videos again. I hope they are very educative, okay, and really giving you the insights of the same, okay. And stay tuned in. I'll be posting another video on about the entries, okay. I'll be posting another video about the entries, how to make entries using the ICT concepts, okay. So thank you for watching, and until we meet again next time, peace, and please subscribe. Bye bye.